Hi everyone, I'm Karunya Rao in Ideas for Profit. Today, the spotlight is on ICICI Bank. It reported a strong earnings in the first quarter of FY22. The private sector lender's profit surged to 4,616 crores in Q1, a 78% growth compared to same quarter last year. The profit growth was essentially driven by solid loan growth, better margins, bounce back in fee income and contained credit costs, partly offset by higher operating expenses. While the overall performance was good, we are most impressed by the robust growth in core operating profit and stable asset quality along with significant provisioning buffer. If we exclude the treasury income and provisions, ICICI Bank's core operating profit increased by 23% year-on-year, despite operating expenses inching higher during the quarter. So what led to the bank's success on this front? Well, ICICI Bank saw almost a decade of underperformance compared to the peer banks due to two crises it faced. First, the retail asset quality troubles in 2008 and corporate bad loan cycle in 2014. The compounded annual growth in ICICI Bank's core pre-provision profit was 11% between FY9 to 19, which is much lower compared to 22% for HDFC Bank in the same period. The retail downturn in 2008 let the bank change its earlier strategy of chasing bulk deposits. The success of the bank's change strategy is clearly visible in its robust liability franchise today. The low-cost CASA deposits now constitute 44% of total deposits. The corporate bad loan cycle prompted the bank to rebalance its loan portfolio in favor of retail loans. Consequently, retail loans now constitute around 61% of total loan book compared to 37% in FY13. Bank's overseas loans declined from 25% in FY13 to around 5% as of June end. Superior funding profile and increased share of high-yielding retail loans has enabled ICICI Bank to significantly improve NIMs on the domestic book to 3.9%, which is a tad below the margins of HDFC Bank. Margin expansion along with strong loan growth aided the high growth in operating income in Q1. ICICI Bank's asset quality has held up well despite COVID-led disruptions. While fresh slippages were high during Q1, management expects additions to NPA to be lower in the next quarter and fall further in second half of FY22. At a time when most banks are shoring up provisions to meet future exigencies, ICICI wrote back 1,050 crores of COVID-19 related provisions created in earlier periods, which boosted Q1 profit. Moreover, the high provision coverage ratio of 78% at end of June is comforting. Strong operating profit, stable asset quality should translate into reasonably healthy earnings growth for the bank over the next 2 years. The strong core pre-provision operating profit will enable the bank to absorb potential high provisions, if any, without denting the balance sheet, and is of course a key reason for our optimism as well. Investors should note that we aren't saying that there will be no more bad loans. If there is a severe third wave, bad assets will inch up. But additional provisions will limit the credit cost and support earnings as potential problem assets are already provided to a large extent. Domestic loan book increased by 20% year-on-year, led by retail and SME lending. After many quarters, corporate lending saw good traction and an uptick of 11% year-on-year. Mortgages saw a growth of 24% YOY. Other segments within retail, especially credit cards, also posted good growth. Despite good pickup in domestic loans, the growth in the overall advances book was a tad lower at 17% because of 15% decline in international loans. This is in line with the bank's strategy to focus on domestic retail business and reduce non-India related overseas corporate exposure. Deposit growth was healthy at 16%, mainly led by 25% growth in CASA deposits. Fee income growth was strong because of base effect. Operating expenses increased 30% year-on-year with normalization in business activity. Consequently, the cost-to-income ratio increased to 40% at end of June. Asset quality fared better with GNPS trending lower YOY and restructured assets at just 0.6% of advances book. With Tier 1 capital adequacy at around 18%, the bank is more than adequately capitalized. It's well poised to capture the growth opportunities in the period following COVID, or rather, as we all call it, the post-COVID era. ICICI Home Finance, which is the bank's subsidiary, posted weak set of numbers on heightened asset quality issues. The impaired loans of the housing finance company stood at 12%. Additionally, around 4% of loan assets were restructured as of June end. Overall, Q1 FY22 earnings reaffirmed that ICICI Bank has transitioned well from a stressed bank to a growing lender. However, the valuation is not yet fully capturing the significant improvement in business fundamentals and the growth story. With With the stock trading at around 1.9 times FY23 estimated core book, the current valuation is still reasonable given that ROE has inched up to 13%. Moreover, the bank's valuable subsidiaries continue to add to stock's performance in terms of relative valuations as well. ICICI is trading at over 30% discount, which is significant to its closest retail lending peer, offering room for meaningful re-rating. Therefore, we advise long-term investors to accumulate the stock.